Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. Last one of the week. It is Thursday, May 9th. Today we're going to take a look at one out of the industrial sector, Norfolk Southern. This is a railroad company. They also have some ports as well, shipping company really. So let's jump into the video. And before we do that, if you could take a moment, if you haven't done so, or if you could help me out, hit the thumbs up button down below. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified anytime we drop any new content. And drop a comment down below. Let me know what you think of the video. Let me know what you think of Norfolk Southern. Again, out of the industrial sector. Doing all of those things, it really does help me out. It doesn't cost you a thing. Well, it costs you a second or two of your time, but doesn't cost you any money. I don't have anything to sell you on this channel. Everything I do out here is free to see. Doing all that really does help spread the word and get these videos out, and I really do appreciate everyone who has taken the time to do that. Let's jump back into the video. This is the Vested Interest Stock Screener. This is how I set up these videos. So we're going to run through this screener here. This is also how I look at a company, right? This is the same screener I use to look at companies to add to my watch list if they meet 5 of 8 or 6 of 9. And then if they make it to my watch list, I do more of a deep dive into the financials. I really probably should do a deep dive video into how I look at a company's financials. But these stock screeners I do Monday through Thursday. Pick a stock that's pulled back on the day so we can take a look at it and see if it's found any or showing any value. And this is exactly how we're going to run through this video as well. And then at the end, we'll look and see if it meets 5 of 8. If it was a financial company, we'd add in price to book. This is not. That would be 6 of 9, right? Price to book. If you're using that for like a bank, Bank of America, JP Morgan, something like that, you could use a 1 being fair value, anything over 1 being overvalued, anything under 1 being undervalued. But for other companies, want to make sure you compare the price to book to other companies in the same sector. All right, enough of that. Back into the video, the real video. www.norfolksouthern.com. That is their homepage where I pull this information from. Go ahead and check them out there if you want to know more about this company. And you should, if you're investing in individual companies, you should know as much about the company as you can. How do they make their revenue? How do they make their money? Are their margins growing? Look at all of the financials of the company as well as the company overall. Again, www.norfolksouthern.com. www.norfolksouthern.com. Company overview since 1827. So this one's been around almost 200 years. We've been moving the goods and materials that power the U.S. economy, customer-centric and operations-driven. We are dedicated to advancing safety, serving communities, and driving innovation for tomorrow's rails. And you can see here to the right, if you go to their homepage, you could actually download a little interactive map, but I just clipped this off there. I hate that it's on an angle like that, but that's Michigan there. That's Florida down at the bottom. This is Texas right over here. It gives you an idea of the map. You should all be familiar with the United States map, but some of you may not be. Maybe you're from another country, but I think a lot of other foreigners would be familiar with the United States map. But this is their rail, so more along the East Coast, a little bit into the, I don't know if Texas is really considered Midwest, East Coast, middle of the country to East Coast primarily. And then the one up above, the ones along the water, right? You can see them down here. That's Louisiana, I believe. Michigan up here where I'm at. Looks like some are down in, was that in Wisconsin or is that Illinois? Illinois, maybe one there on the border of Indiana. But anyways, around the water, and then these are other facilities they have outside the ports, right? So the rail, the ports, and they are a shipping company. That's what they do. Now, the reason we're taking a look at them, down 2.5% on the day. Norfolk Southern Corporation is who we're talking about, ticker NSC. They are out of the industrial sector, closed out the day at $226.33. 52-week range as low as $183.09, as high as $263.66. They would need to drop right around $210 per share to be within 15% of their 52-week low. So they are not quite there yet, so they don't meet that metric. Market cap of $51.131 billion, a beta of 1.3, so more volatile than the overall market. And you can see that this is just a one-day chart, and you can see how volatile it is over one day. And you could go look at, again, if you were to go to Yahoo Finance, where I pulled this information from, not affiliated, you could look at a 5-day, 3-month, 6-month, 1 year to date, 1 year, 5 year, or all the way back and see how volatile they are. But 1.3 is more volatile than the overall market. PE ratio is very elevated, in my opinion, on this one, $36.39 per share. This would be more in line with a fast-growing tech company, right? EPS, earnings per share, sitting at $6.22 per share. Next earnings date coming up July 25th through July 29th. Forward dividend is $5.40 paid out in the year. They are a quarterly payer, I believe, so divide by 4, though we will see that here in a little bit. Nice starting dividend yield of 2.33%. Ex-dividend date was May 2nd, so we're just past that. So those of you who owned this will get a dividend on May 20th. And 1 year target estimate of $272. So they see it setting a new 52-week low from where it's at. So some upside potentially in the price per share. Now we're going to take a look at dividend yield theory to see if this one is potentially undervalued. To do that, we look at their 5-year dividend yield average of 1.94%. We compare it to their forward or current dividend yield or forward, same number, 2.33%. And since it is higher, that speaks to some undervaluation on this one, at least according to dividend yield theory. Now, here's what I don't like. I like a payout ratio of 75% or less. This is at 86.96. That's too high for me. I start to get worried about a company if they have a bad quarter, they suffer through a slow time or a recession. People aren't shipping goods in this case since they're a mover of products by rail and by port. I would be concerned if we entered a recession, for example, that they do not have much of a buffer here in free cash flow as far as the payout ratio to maintain that 2.33% dividend. I also worry about, are they able to raise the dividend over time? So I like 75% or less. This would not meet the metric there for me. Now we're going to jump down into the financials a little bit. And if you were to go to Yahoo Finance, over here on the left, there's a lot of tabs you could click on, right? This is the initial chart tab. Then you'll have analysis tab, statistics tab. That's where you find the dividends and splits and dividend yield theory. That's where I do that. And financials down at the bottom. And in financials tab, you're going to find their cash flow statement as well as their balance and income statement. And there's a lot of good information there. You can find out how their revenue is doing. Is it growing over time or is it decreasing over time? They do a 4-year time period. You can look at margins. Are they expanding or decreasing over time? Do they have more debt than equity or less debt than equity? Are they paying down debt? A lot of good information there that you should be looking at in the balance sheet and income statement if you are investing in individual companies. And if you do not want to do that type of deep dive, you should be investing in ETFs or index funds. Warren Buffett always recommends some sort of S&P 500 index fund. VOO would be a good example. SPY would be another one. Something like that matches the S&P 500. That would be my suggestion as well. I do VTI, which is the whole stock market, which would be a good one as well. Now, we're going to look at free cash flow. We want growing free cash flow over time because we want growing dividends over time. And typically, if a company has growing free cash flow, they have growing dividends. It also will help reduce this payout ratio. 2020, $2.1 billion. 2021, nice jump up to $2.7 billion. Things get a little tricky here in 2023. They dropped down to $2.2 billion, and they continued that trend down in 2023, down to $830 million. And that is a big drop. Not only did they drop down in free cash flow, they really cut off their repurchase. You see this line here, repurchase of capital shares. They were at 1.4 million in 2020. 3.3 in 2021, a little bit lower in 2022 to 3.1, but then 2023 down to 622 million. So I like that they're buying back shares, but I do not like that since 2021, it looks like we have decreasing free cash flow and have significantly decreased their repurchase of capital stock. But I do like that they're repurchasing their shares. They continue to do that over time. That will also help with this payout ratio. But 86% is much higher than the 75% or lower I look for. So free cash flow, that would not be a check on our chart. Now, 18 analysts have taken a look at this over at stockanalysis.com, and this is just another source that I like to go to. You pick any sources that you like. Just make sure you're not blindly following just one source. You're looking at 2, if not 3 different sources. To make sure the information you're getting is accurate and up to date. And stock analysis goes back further in time than Yahoo Finance does, and it provides the information in a very user-friendly manner. I like this analyst tool here. 18 analysts have taken a look at this, and if you were to go to the homepage, you could see how many might call it a strong sell, hold, buy, strong buy. Of the 18 analysts, obviously more are calling it a buy or a strong buy right now. I don't know that I definitely agree with that, but that's what they are calling it at the 18 analysts currently. And they have a low estimate of $175, which would be a $22 or 22.68% decrease from where it currently sits. Average estimate $261.50. Excuse me. which would be a 15.54% increase from where it currently sits. And that's pretty close to what we saw with Yahoo Finance estimate over the next calendar year. I think they were in the 270 range, but pretty close at 260. And high estimate of $305, which would be a 34.76% increase from where it currently sits. All the while, you could collect that 2+% dividend yield. Now, we're going to get into statistics here. We're going to look at return on equity and return on invested capital. I like 10% or better for these numbers. 11.20 for return on equity meets that metric there. Return on invested capital is low, 6.28%. That does not meet the 10% I look for, so that would not be a check mark for me. EPS growth, I like 5% or better. They're at forecasting 18.78, so that would be a check mark for me. And nice revenue forecasted at 4.79%. Let's wrap this one up. Look at the dividends real quick. So quarterly payers, we said high payout ratio, 86.96. Don't like that. Dividend growth to 4.25% though. Even with the high payout, that's 4 points. So I would question whether or not this is going to be stable and ability to maintain it with such a high payout ratio. 7 years of dividend growth, buyback yield to 0.83%, shareholder yield to 3.23%. Decent. Dividend history going back to 2021, they were paying $1.09. In February 2022, they jumped it up to $1.24. February 2023, $1.35. Looks like they've maintained it since February. I'm surprised they didn't increase it here in the February. So again, with such a high payout ratio, unless they raise it here in the next couple quarters, they could be in risk of either maintaining the dividend or cutting the dividend. I mean, I would recommend maintaining it with such a high payout ratio, but that's just me. So now we'll go back to the stock screener. Yep, we understood the business. That's where we started. They did not have growing free cash flow. They do have a growing dividend, 4.25%. Payout ratio is not 75% or less. It is 86+%. Valuation and dividend yield theory does say it's potentially undervalued, but that is just one metric, right? That we don't blindly follow just one metric. If the other metrics don't look good, we have to take that with a grain of salt. Buy below current cost basis or within 15% of 52-week low. It is not there. It needs to be $210 or lower, $210 and some change and lower. Return on invested capital, return on equity equal to or greater than the industry average of 10% or 10% plus. I usually stick to 10% plus. No, it did not meet. One of them was, the other one was not. Earnings per share growth greater than 5%. Yes, check there. It was not a bank, so we didn't look at price to book. 1, 2, 3, 4. Only 4 out of 8. This would not make it on my watch list. That's just the way it is. That's why I use the stock screener. Take the emotion out of it and let the screener decide what makes it past your initial screening. And you set up your own screener. You don't have to use this one. Maybe you have different criteria. This is just to give you an idea how you can use a screener to screen stocks. Well, that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Norfolk Southern you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below. I'll work it in the rotation. And yes, for the individual that asked about Visa, I will do Visa, but Visa has been up, I believe, every day this week. I'm just waiting on a day for it to pull back so we can take a look at it as a group. But it is on my list. We will get to it. I really appreciate the suggestion. And with that, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. I hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion in investing for educational and entertainment purposes. Investing involves risk. Canada's money, and should never invest any amount that comes losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counsel certified financial advisor.